Almost every prominent trading channel seems to talk about daily bias, as it seems to be the new buzzword. But the way they are using daily bias will result in guaranteed losses. So let's get started, as in today's video we will be discussing the wrong way of looking at daily biases, areas to draw correct daily biases from, which includes weekly highs and weekly lows, structural highs and lows, and higher time frame PD arrays. Also, we will be looking at how I use the daily bias with economic calendar to snipe entries, and this is the most important part of the video. So first of all, let's see what most ICT traders do wrong when identifying daily bias. They go short when the daily high, that is this level, gets swept, and they go long when this level, that is the daily low level, gets swept. In theory, this seems a quite practical approach, but when you backtest this strategy, you will come to a conclusion that you have a low win rate and a low RR. I did backtested this strategy on the pairs GBP USD and Euro USD and found out that my win rates were 40% and my average RR was 0.9R. This means that if you apply this strategy, you won't be profitable. Let's move on to the charts to see how this strategy is not profitable. So as you can see here, we are on the Euro USD daily chart. This is the previous day high. This is the previous day low. So now if price comes and takes out this high, I would look to short according to the strategy of most ICT traders, and if it comes and takes this low, I will look to long. Also, a thing to remember here is that if price comes and takes this daily low and comes back inside, then if I take a long trade, my target would be these highs according to the strategy. So let's move forward and see how many successful trades we get. So here you can see price took out the low, and according to the plan, I placed a long here with a stop loss right below the lows and targeted these highs. Let's see how my trade play out. So as you can see, we booked a 1 hour loss here, so we can write in the loss column 1. Now let's move forward and trade this strategy further. Now if I will get a sweep of this high, I will look to short, and if I will get a sweep of this low, I will look to long. So let's play it forward and see which type of trades we get. So we did sweep the low, and let's say I place this long setup here with the stop loss right below here according to the strategy, and I targeted at least these highs to be reasonable with the strategy. Let's play it forward and see what happens. You can see again a stop loss hit. So we are currently in a 2 hour drawdown. So let's continue this strategy and play it forward further. Let's suppose this is a new daily high and this is a new daily low. Let's continue it forward, and now if I get a sweep of these highs, I will look to short, and if I get a sweep of these lows, I will look to long. So let's play it forward and see what happens. Okay, so I did get a sweep of these highs, then I took the trading tool. Let's take this tool and place a long here with a stop loss on these lows and target these highs. So let's play it forward and see what happens. So again you can see we took a loss here and we have a total of a 3 hour drawdown. So you can backtest this strategy for yourself. The point of showing this was that the basic ICT method that most traders are using, that is, they try to short at the sweep of the daily high and they try to long at the sweep of the daily low, is quite a retail pattern and doesn't work anymore. So now how to mark the correct daily bias? So firstly, let's understand what is a daily bias. Daily bias is basically not a preconceived bias that you have, but it is the act of anticipating where price will go after market open and then taking a trade when your rules are met. So let's suppose you have a bullish bias. That doesn't mean you will apply buy the dip strategy and buy every down candle at the 1 second time frame. However, you will wait for price to come in the discounted PD arrays and then long. So there are basically 3 types of high probability daily bias zone. Firstly, we have the weekly highs and weekly lows. Secondly, we have the structural highs and structural lows. Thirdly, we have the higher time frame PD arrays. We will look an example for all of these. So let's first come on to the weekly highs and weekly lows. So the basic checklist before taking a trade from the weekly highs and weekly lows is that firstly, you must identify the higher time frame trend and take the trade only if it aligns with the higher time frame trend. So let's look at this example. You can see that the trend here is to the downside. Price is creating lower highs and lower lows. So it makes sense to take short trades when the weekly highs are swept in this scenario. Now our second point is that we must mark the weekly highs and lows and take a trade if there is a failure to displace pattern or a liquidity sweep pattern that aligns with the higher time frame bias. Let's clear this point at the chart. So here you can see we have a weekly high and we have a weekly low, and the overall trend is bearish. So if price comes and takes this weekly high, which I am also marking with an arrow, takes this weekly high and gives a failure to displace pattern, that is, it comes back again inside the range, this orange range. This means there is weakness in the chart and you could start shorting. Also, the overall trend is bearish. So our two conditions are met. Firstly, the overall trend is bearish. Secondly, price came, took the highs and gave a failure to displace pattern. Now let's move on to our third point. The third point is that the probabilities of the trade increase if there is a higher time frame PD array above or below the weekly highs or lows. So basically PD arrays are of three types: FVGs, order blocks and liquidity. If you want to know more information on this, I have previously created 3 separate videos on each of this topic, which you can view after this video. So let's look at the chart as to what we mean by the third condition. There must be a higher time frame PD array below or above the weekly highs. You can see this is a bullish order block and this is on the weekly time frame. So our third condition is also satisfied because bullish order blocks is a weekly PD array on the higher time frame which is tagged by this weekly high. So all three of our conditions are fulfilled. Firstly, the trend should be bearish. As you can see, it is bearish, it is fulfilled. Secondly, it must sweep the weekly highs and give a liquidity sweep. Thirdly, price must tag a higher time frame PD array. So it tagged the bullish order block on the weekly time frame. So third condition is also met. All three conditions are met, so you can take a trade on the weekly time frame according to the bias. Now let's come to our second high probability area for identifying daily biases, that is structural highs and lows. So let's see the checklist that we must keep in mind before taking a trade on the structural highs and lows. Firstly, we have the condition that go to a time frame of minimum of 4 hours and identify the trend. Make sure your bias is aligned with the trend. So let's see on the chart what do we mean by that. So here we have a bearish trend in the market. So our trades and our bias should be bearish and we should be looking for shorts on a sweep of these highs or on a sweep of these highs. We should be looking for shorts, not for longs. Now let's come on to the second point and see what we have in the checklist. Mark the immediate structural highs and lows and take a trade if there is a failure to displace pattern or liquidity sweep that aligns with the higher time frame bias. So let's see on the chart what does it mean. So here on the chart, what are the immediate structural highs and lows? According to my analysis, these are the structural highs and this is the structural low. That is the most immediate high and low. Now if price comes and takes these highs, such as here, we will look to short. Also our bias on the time frame is bearish, so first condition is satisfied. Secondly, price came and took the highs on the immediate structure, which gave us a short opportunity, so the second condition is also satisfied. Now let's see what the third condition is. The probabilities of the trade increase if there is a higher time frame PD array above or below structural highs and lows. So let's see this as well. So here you can see on the chart we had a fair value gap on the 4 hour. Here you can see this is the fair value gap. Price came and not only took this structural highs but also tagged this fair value gap. So which means that all three of our conditions are satisfied. Firstly, the trend should be bearish, that is satisfied. Secondly, there should be a sweep of the structural highs, which is done here. Thirdly, price must tag a higher time frame PD array, which is this fair value gap, as you can see here. So the third condition is also satisfied. Every condition is satisfied, so it makes sense here to take a short trade with our bias being bearish. Now let's come on to our third type of high probability zones to mark a daily bias, that is higher time frame PD arrays. Now PD arrays are basically FVGs, order block and liquidity, and I have made a separate video on each of these topics which you can view in the playlist below. Now let's see what is the checklist for taking a trade from higher time frame PD array according to our daily bias. Firstly, you must go to a time frame of minimum 4 hours and identify the trend. Make sure your bias is aligned with the trend. Now here on the chart example, you can see we have a bullish trend. So our bias should be bullish, and we should be looking to long if price comes in any of the higher time frame PD array. So let's move to our second condition, that is mark high probability PD arrays such as overlapping fair value gaps. Now if you don't know what are overlapping fair value gaps, I would recommend you to see the fair value gap video. So let's see in the chart example what do we mean by this second point. So here you can see we have a orange box marked as the fair value gap, and we have also a bullish breaker here, and you can see this breaker overlaps with this fair value gap, so we will call this as overlapping FVG, and hence this FVG gets high probability FVG. So it would make sense to take trades from here when price come and tags this fair value gap and goes ahead. So two of our conditions are satisfied. Firstly, the overall trend should be bullish. Secondly, whenever price tags a higher time frame PD array, you take a long. So I hope it is clear up till now. Now let's move to our third point. If the consequent encroachment is respected, then it becomes even more high probability. So basically consequent encroachment is 50% of the fair value gap. And if the 50% level of the fair value gap is respected, the trade becomes even more high probability. Now let's come on to the last topic and one of the most important topics as to how I take my trades by aligning the daily bias with the economic calendar. So statistically, it is proven that in forex market and commodities market, futures market, the most market participation and the highest volume occurs at news events. So it makes sense to trade after news events once a clear direction is found. Firstly, you must mark the daily bias in any one of the three ways shown previously in the video. Once you have marked the daily bias, you will take a trade when price has purged your desired area on news and most of the market participants have been shaken out due to news volatility. Now let's see an example of this on the charts. Let's go to the previous example of Euro USD. And suppose I was bearish here because firstly the higher time frame was bearish, secondly the immediate structural highs were swept, thirdly price tagged a fair value gap PD array. So all three conditions of marking a daily bias are satisfied. Now to make it more high probability, I will wait for the news, and as you can see this liquidity purge in the fair value gap happened at the news. So this would be the perfect time to take a short trade here with a stop loss above the fair value gap and targeting these lows. So if anything is unclear, you can ask in the comments below, and the PDF document is attached in the description, so you can download it and review it in your spare time. Thank you for watching.